Assume this is the forward rate, then party B has to pay this much amount of dollars to party A. They will get it. Party A will get that. So the base currency amount is fixed. Generally, if you want, you can do other way around. You exchange the fixed base currency amount at the spot rate and at the spot date and the forward date, but the amount in counter currency depends on the spot rate and the applicable forward rate. For the spot leg or the near leg, you apply the spot rate. For the far leg, you apply the relevant forward rate. Is it clear?
Yeah.
Assume this is the forward rate, then party B has to pay this much amount of dollars to party A. They will get it. Party A will get that. So the base currency amount is fixed. Generally, if you want, you can do other way around. You exchange the fixed base currency amount at the spot rate and at the spot date and the forward date, but the amount in counter currency depends on the spot rate and the applicable forward rate. For the spot leg or the near leg, you apply the spot rate. For the far leg, you apply the relevant forward rate. Is it clear?
Yeah.
I mentioned earlier, when you ask for a, before that, tell me what's here. In a SOP, spot rate 1.1235 and 1.1258 is the forward. The difference is 23 points. Is the spot forward points. The same points are applicable, or the same rates are applicable even for the SOP transaction. That's why we call them as SOP points as well. For a SOP transaction, what would be the points that you pay or receive? That's why we call them forward points for the SOP points. In a SOP transaction, there will be a spot and a forward, or a forward and a forward. The difference between spot and forward is the number of points. So that's why we call it as SOP points as well. Is it clear? So even for a SOP transaction, when you ask for a quote, they will quote again bid and ask. Say like 23, 28, something like that. They just quote the SOP points or the forward points. Then you know, you do the spot transaction. If you want to buy in the forward, you have to add 28 pips to the spot rate. If you want to sell it in the forward as a market taker, you have to add 23 points to the spot rate. Clear?
Yes, sir.
Okay. Now we'll discuss how do you get these points directly without calculating the forward and then subtract it spot rate from that. To do that, if we take the forward equation, this is the forward transfer. To get the forward points, what do we do? Subtract the spot. So we do the same here. The right hand side, this is common factor. We can take it out. Then use some algebra to make it this part as the common denominator. You will get 1 plus RC d over 360 minus 1 plus RB d over 360, whole thing divided by 1 plus RB d over 360. Can you see the bottom of the? You can see this. Okay. So 1 minus 1 will cancel out. Then it will be RC, counter currency interest rate, into this fraction minus base currency into this fraction. That can be written as S times RC minus RB d over 360 divided by 1 plus. You can use this equation to calculate the forward points straight away. But remember, the answer for this from this equation would be in decimal form. Again, you have to drop that decimal point and write it as full figures. Is that okay if I delete this, erase this?
So please wait, please. Mute to me.
May I delete this?
Okay, okay.
Now, So we discuss about bid ask for spot trades and forward points. But when we calculate forward points with the forward rate, we need to interest rates. Interest rate on the counter currency and the interest rate on the base currency. So this bid ask spread or the bid ask concept is applicable for the interest rates as well. It is applicable for the interest rates as well. So we'll discuss how to use bid and ask interest rates to calculate the forward points. So for that, I think it's better go to slide number 22. Slide number 22 of the FX introduction 2. In that it says Euro USD, sorry, Euro AUD spot rate is 1.4095. Interest rate on Euro for 6 months 1.45, 1.50. AUD 6 months 5.05, 5.1. If you want to find the bid of swap points, what do? You can use this equation, but to calculate the bid of swap points, you use the bid of counter currency for the interest rates and the offer of base currency. Before we come into that, let me make you clear. What does it mean by 5.05 and 5.1 as a market maker? As a market maker, you borrow Australian dollar for a 6-month period at 5.05%. As a market maker, you borrow Australian dollar for 6 months at 5.05 as market maker. Then as a market maker, you lend Australian dollars for a 6-month period at 5.1. So you pay less, you charge more. You pay less, charge more. The same concept applicable here. As a market maker, if you want to borrow euros for 6 months, you pay 1.45%. If you want to lend for a 6-month period, you charge 1.5%. So that's the concept in bid and ask for interest rates. So whenever you want to calculate soft points directly, or not only directly, the same concept is applicable if you want to calculate the forward rate. In our previous example, when we calculate the forward rate, we just use one interest rate, meaning for one currency. For each currency, we use one interest rate. There were no bid and ask rates for interest. But in reality, you borrow at a one rate and you lend at another rate. So you have to play with these figures. This is the concept. To get the bid, you use the bid of the counter currency and offer of the base currency. The other way around, when it is offer, when you want to calculate the offer rate, you use the offer for interest of counter currency and the bid of base currency. You use to calculate the offer points, sub points, use the offer of the counter currency for the interest rate bid of the base currency. So we'll follow this rule and see whether we can get the given answer. So bid, calculate the bid points, bid forward points. We use the equation counter currency interest rate minus base currency interest rates into a count convention divided by 1 plus R base D 360. What are the applicable rates? What is the counter currency? Is Australian dollar. In this pair, counter currency is Australian dollar. Base currency euro. Then, since we are calculating the bid for the counter currency, we use the bid of the interest rates. What is the bid? We use bid interest. Okay. These are the two quotes for the Australian dollar. Bid is 5.05. For euro, we use the offer rate, which is 1.5. Bid rate is 5.05, offer rate is 1.5. Now we subtract these numbers. Spot rate is given into this. spot rate is 1.4095. If RC, this is RC, this is RB. What's the figure that we have to write here? Is it 5.05? If you write it as 5.05 minus 1.5, correct, but you have to divide it by 100. You have to divide it by 100. Remember, in this equation, we assume interest rates are given in decimals, not as a percentage. But here, 5.05 and 5.1 are given, and not only that, 1.45, 1.5, all interest rates are given as percentage. So we have to convert it into decimal. 6 months. Here we assume 180 days for 6-month period. Divide by 360. Whole thing divide by 1 plus interest rate on the base currency 1.5, again divide by 100, 180 divided by 360. What is this 180? We assume for 6-month period there are only 180 days. So simplify this, you would get 0.0248. So that's why it's given as 0.248 points. Got it? Is it clear? To calculate the bid points, then we use the bid of the counter currency for the interest rates and offer interest rate for the base currency. If you want to use calculate the forward rate, the same concept. If you use the forward rate equation and use these two interest rates in that equation and the spot as this, your forward rate would be 1.0143. If you use these two interest rates and this exchange rate to calculate the 6-month forward, you should get this forward rate, which implies the difference between these two as 248 points. Clear? Okay, then we'll calculate the offer. To calculate the offer, still the same equation, offer of forward points. What we use for interest rates, we use offer rate of counter currency and the bid rate of the base currency. So what is RC? For the counter currency, we use the offer rate. Counter currency is Australian dollar. For Australian dollar, offer interest rate is 5.1. Bit rate of RB, bit rate of the base currency is 1.45. The spot rate is given. Substitute these figures into this equation. Spot rate is 1.4095. RC 5.1. I can write it straight away as a decimal. 0.051 minus 1.45 again into 180 divided by 360, everything divided by 1 plus interest rate for the B. You would get 0.0255. That means 255 points. There may be a small rounding off. So from here to here is the use of the calculator or the now Excel, but in the exam you have to use the calculator. But remember the equation and selecting the correct interest rates and substitute those interest rate and exchange rate properly into the equation. Once you get the answer, convert it into points. Any questions? Any questions, please? We are going to take a break. Before we go into a break, if you have any questions, please ask. So if not, we can take a break about 15 minutes. During the break, you can think and come up with questions. That would work. Agree?
We'll meet.
Okay, then we'll stop for a break and come back in 15 minutes. The net position would be euro 6 million, but negative. You don't have 6 million euros to deliver this because you had only euro 4 million, but you sold euro 10 million. Now you need 6 million more euros. You are having a negative position in euro. We call that as a short position. Now you have a liability. Now you have a liability in euro. We call it as a short position. So in summary, when you have net assets, in a currency, we call it is a long position or a positive position. When you have net assets, we call it a long position or a positive position. Or when you have net liability, we call it as a short position or a negative position. Clear? When you have net assets, you are long. When you have net liabilities, you are short. That's the basic concept of going long and going short. So if we go back to the presentation and slide number 7, there's a blotter. What is a blotter? Blotter is a record of all the transaction a trader did during the day. That's the blotter. You can see it in the first row. You can see euro 1 million rate is given 1.3995 counter currency dollar amount. Dollar amount is negative. That means trader has bought euro 1 million at 1.3995. So in dollar amounts, it's $1,399,500. Then he has done a second trade. Again, he has bought euro 3 million at a rate of 1.3998. The equivalent dollar amount is given in the last row. Likewise, he has done 5 transactions.
So excuse me,
Yes.
is this PDF provided to us? Like I couldn't. What you mentioned, this lottery thing is.
Yes, this was distributed even before the we closed for the lockdown.
Okay, hard copy. Yes.
Hard copy. Yes,
Okay.
I think they might have emailed this one as well, but you should have just one presentation on introduction to FX hard copy.
Yes.
You should be able to find see this slide in that one as well.
Okay.
Okay, so the net position is shown. What is the net within bracket? Say for the example, in the third row, you can say euro 2 million within bracket. What does it mean? The trade has sold euro 2 million, so negative figure, and therefore the counter currency amount is positive. When you sell euro, you receive dollars. So the net position is the sum of all the above trades. So there were 4.5 purchases and 3 million sales. So the net is euro 1.5 million. Then you net the dollar amounts, you just add them, then you get 2,099,650 as the dollar amount. 2,099,650 is the dollar amount. How do you get the average rate? You divide the dollar net amount by the euro net amount. That is divide 2,099,500. 1.5 million. You get the average rate. This is the average rate of his position of euro 1.5 million. That's the average. After doing the 5 transactions shown above. So he's having a long position. Then the next row, it shows the market rate, but now the market exchange rate is 1.4002. Then if you sell 1.5 million dollars, sorry, 1.5 million euros at the market rate, you get 2,100,300 dollars. But your cost is only 2,099,650. So if you sell that 1.5 million euros now at the market rate of 1.4002, you get a profit of 650. So that is the mark to market profit of all these trades, or the net position. If you sell it, you will realize that. Otherwise, it's just a mark to market profit. That profit will change with the change in the interest exchange rates in future. So that's yes.
The countries like Sri Lanka, what is the most appropriate maintaining a long position or short position for banks? Of course, you have provided some open position limits.
Yes.
Is that something like that? Just want to
Yes.
know.
So this his net position is 1.5 million euros. So this is his net position in euros, but in Sri Lanka, or especially in risk management, we'll discuss about net open position. It's about a control on the risk of the FX risk. So in that you have to net all the exposures in different currencies. So you may have exposure to euro, you may have exposure to dollars, yen. You put everything together in terms of dollars and find what is your exposure, whether you have more exposure to foreign currency or you have negative exposure to foreign currency. Either way, whatever the exposure, with the exchange rate changes, your profit increases or decreases, or you may incur a loss or you increase your loss. To minimize that net open position uh, limit is imposed. It should be by the management of the bank itself and from the regulatory point of view by the central bank as well in Sri Lankan context. That is the net open position. We will discuss this in FX risk management in detail. The first question that you ask, what is the appropriate, whether you should maintain a long position or whether you should maintain a short position, that's your view. You have to study the market and develop a view whether exchange rate rupee is going to depreciate or appreciate. So that's a good question. So we'll move into this. Assume now you have a long position, euro 1.5 million. Current market rate is 1.4002. In terms of dollars, what is the amount of this euro? It's 1.5 million into 1.4002. In terms of dollars, it is 2,100,000 and 300. This is the dollar equivalent of your position. 1.5 million euros at the current market price. You get 2.1 and 300 million dollars. What would happen if the exchange rate moves to 1.4012? Your long exchange rate increases. In this instance, exchange rate increases means appreciation of what currency? Base currency or the euro or the dollar. If exchange rate increases to 1.4012, what is the currency appreciate? Which currency is? So in this example, euro, the base currency, why? You have to pay more dollars to buy 1 euro. So you are long base currency appreciate. Will you make a profit or a loss? So what you have to do, calculate the dollar equivalent of 1.5 million euros at this rate. $1.5 million into 1.4012. What is the answer? this number would be higher than this number. I think it's sorry, no. This is the amount. So in terms of dollars, value of your position has increased when the exchange rate or the base currency appreciates. So you have a long position in base currency, base currency appreciates, you make a profit. So then no need to say what would happen if base currency. Instead of 4012, if it goes to 3992, exchange rate decreased. That means in this pair, euro depreciates. Then value in dollars will go down. So you lose. Again, in summary, you have a long position, base currency appreciates, you make a profit. If base currency depreciates, then you make a loss. When you have a long position in base currency, then what would happen when you have a short position? That means you have a liability. You have to pay to someone else. You have a short position in base currency. Base currency appreciates. What would happen? You have a liability, so you have to buy. You have to buy to pay that. When you try to buy, in terms of counter currency, you have to pay more. That means you make a loss. To buy, you have to pay more, so you make a loss. If the base currency depreciates, you can buy it at a cheaper rate, so you make a profit. Clear?
Yes, sir. When it comes to selecting the base currency, say for a traditional commercial bank, the base currency would be LKR. Is it
No.
in Sri Lankan? Okay.
No.
For the
That's what we
that
discussed at the beginning.
Okay.
In currencies like this, Euro USD, Euro is the base currency. USD LKR, USD is the base currency. What is the base currency? In which the price is quoted in another currency. So here, price of euro is quoted in dollars. price of euro is quoted in terms of dollar. So the euro is the base currency, dollar is the counter currency. In dollar rupee, price of $1 is quoted in rupees. That's why we say 100 exchange rate is 186. 186 is in rupees, not in dollars. So $1 is equal to 186 rupees. Got it? So therefore, dollar is the base rate, rupee is the counter currency.
Okay, thank you, sir.
Clear? So you have to be very clear about the basic concepts: base currency, counter currency, direct quote, indirect quote.
That is the very reason where the Sri Lankan banks give open limit, like the open limit in dollar terms, like 10 million plus or minus something like that.
Yes,
given.
yes. The open position, net open position is given in terms of dollars, because that's the currency that we deal in terms of
Correct.
amount of dollars. We don't say I want to buy 1 billion rupees against dollar. We say $1 million. So in the FX market, it is easy to use base currency always. It doesn't say that you cannot use counter currency amounts. You can do that. Then the calculation would be on the other way around and would be difficult. But if you know the concept, you can do that. Because for that, what you need is the concept that we discussed, reciprocal rate. What is that? If USD LKR is 186, what is the LKR USD rate? What does it mean? USD LKR 186. $1 equals 186 rupees. Reciprocal means 1 rupee equals how many dollars? To get that, we do this 1 over 186. This will give you some difference like this. Then if you know this rate, you want to calculate the dollar amount of 1 billion of rupees, you can do that. But generally, nobody follow this. We follow the base currency. We deal in amounts in base currency. Any other questions? Is it clear what is a long position? And what is a short position? And what is the impact of exchange rate movements? You have a long position, base currency appreciate, whether you make a loss or profit. You have a short position, base currency appreciate, whether you make a profit or loss. Is it clear? Or any questions?
Clear, sir. Clear.
Sorry?
It was clear.
Okay. So then we can move into the other presentation about arbitrage. Is it okay? Are you ready to move into that?
Yes.
You can see the presentation. Yes.
Yes,
Yes, you can see.
can see.
Okay. What is an arbitrage? This is not a concept applicable for FX again. This is a generic concept, general one. So basically, what does it mean? You don't take any risk, but you make a profit. Generally, in the financial market, you take at least one form of risk to make a profit. If you lend, what is the risk that you take? You take the risk of the counterparty. That party may not pay it back. So that's the biggest risk in that business when you lend. In foreign exchange, if you buy, what is the risk? The exchange rate may move against you. You have bought dollars, rupee appreciates, then you lose. So, but in arbitrages, you don't take any risk or take very minimal risk. Especially, you don't take the risk of the price changes, exchange rate changes, or change in prices of any other asset. But you can make a profit. Though it's say you can earn a risk-free return. Again, this is with respect to market risk. That means the movement of prices are the asset prices. Still, you have to do transactions with other counterparties. Then you take the risk of the other counterparty. This is the basic concept behind arbitrage. You would see these opportunities in the market. It's not easily visible. You may have to explore. So with regard to FX, we can talk about three arbitrage opportunities: spatial or two currency arbitrage, and the next one is triangular arbitrage that refers or relevant to the cross currencies, and the covered interest arbitrage that relates to the forward exchange rates, forward market. Spatial or the two currency arbitrage maybe in spot market or forward markets, or maybe in the cross currency, wherever. But triangular arbitrage specifically in the cross rates. Covered interest arbitrage is in the forward markets. So what is the spatial arbitrage? Basically in this, in two different places, you might see two different prices for the same thing, for the same asset. Here we talk about FX, so I'll just take FX examples only. So you can see in this example, two banks have given two quotes for Euro USD. Bank A quotes is 1.1520 and 25. Bank B 1.1530 and 35. So you are a market taker. Bank A and Bank B are market makers. They have quotes two prices. Maybe Bank A may be in Singapore, Bank B may be in UK or German or somewhere else, or maybe just in one trading platform. But still, you can see these two quotes. How do you make a profit? For that, you have to have some understanding about bid and offer. What is this 1.1520 meaning? That means as a market taker, we can sell euro at this rate. We can sell 1 euro at 1.1520. And from the same bank, if we are to buy euro, we have to pay $1.1525 per 1 euro. So if you buy from the same bank and sell to the same bank, you make a loss, 5 pips. Bank B also same. If you buy from the bank B, you have to pay 1.1535. If you sell to the bank B, you get only 1.1530. So the bank will make a profit, you will make a loss. But if you see carefully, you can see the offer of the bank A 25 is lower than the bid of bank B. So what does it mean? You can buy euro from bank A paying $1.1525 per euro, and you can sell it to bank B same time at the rate of 1.1530. The 5 pips difference is the profit. If you can enter into these two transactions very quickly before they move their prices, you don't take any risk. Once you enter into these two trades, wherever the market moves, you have already earned the profit of 5 pips, the difference between 30 and 25. This sort of arbitrage is called spatial arbitrage. So you can see two different quotes for the same asset in two different markets, or two different places. It can be other way around. So however, you should be able to buy at a lower price and sell at a higher price same time without taking any market risk. So given these quotes, there's an arbitrage opportunity. You can buy euro, 1 euro, any amount. If the quote is valid for that amount, you can buy euro at 1.1525 and sell it to bank B at 1.1530, because both quotes are quoted at the same time, not in two different times, at the same time. So you should be able to trade very quickly at these two rates very quickly. So say you call bank A and do the transaction, you bought at 25, and then you call bank B. If they don't quote this now, you cannot make that profit. So you should be able to very quick and hit both prices very quickly. What would happen whenever you see this sort of opportunity? It's not only you, even the other parties might see this. What would happen? Everybody will start to buy from bank A. What would be the action of bank A? They see there are a lot of buying pressure, so they will increase the quotes. Instead of 25, they put 26. Then they see another more buying, they will increase to 27, 28, 29, like that. Meantime, bank B sees lot of selling. To explore this arbitrage opportunity and make a profit, you have to buy from bank A and sell to bank B. Bank A sees lot of buying, bank B sees lot of selling. When bank A sees lot of buying, they will increase the price, and when bank B sees lot of selling, bank B will decrease the price. So ultimately, very quickly, in no time, it will come to a equilibrium. So price of bank A and bank B will be almost the same. At least this spread won't be there. This 5 pips difference between 25 and 30. So if I write these are the two codes. So therefore you can buy at this rate and sell at this rate. You can buy at 25 and sell at 30. But what about this situation? 1.152328, 2328, 2025. The bid is higher than the bid of the party A. Offer is higher than the offer of party A. But there's no arbitrage opportunity. You can buy at 25, you have to sell at either 20 or 23. So you lose. You can buy at 28, you have to sell at 20 or 23. So therefore, no need to be the same prices in bids and offers. There can be deviations. No need to have the same spread price file. This can go up. So even 26. It may be the case, or maybe 25. Still, there's no arbitrage opportunity. So you have to be very careful and look at the codes very carefully. This is about spatial arbitrage. The reason it says two currency arbitrage is it involves only two currencies, just one currency pair. That's why it's called two currency arbitrage. Let's move to the more important thing, triangular arbitrage. You may remember we discussed about cross rates. 4 weeks ago we discussed about cross rates. Euro USD, GBP USD, then what would be the Euro GBP rate? Given these two rates, what is the rate? What should be the rate between Euro and sterling? So it may be USD JPY, USD LKR. Then what is the exchange rate between JPY LKR? We discuss how to calculate these things. The arbitrage opportunity exceeds. So given these two figures, we can calculate a exchange rate for the cross currency pair. We call it the implied rate. Implied cross rate given the exchange rates of other two pairs. When there's a difference between implied rate and market codes, whatever the code that you can see in the Euro GBP is different from the Euro GBP rates implied by the dollar, Euro dollar and sterling dollar rates, then there will be a arbitrage. When there's a difference between implied rate and market code, then there's an arbitrage opportunity. So that's why it says price discrepancies between three currencies cross trades that will lead to arbitrage opportunities in FX market. So we'll take an example. So market codes are given: Euro USD, AUD USD, and Euro AUD. So what does it mean? In the market, you can see these codes. For 1 euro, you have to pay $1.0753, or you will receive $1.0753 per euro. For Aussie dollar, 1 Aussie equals $0.6535, and for euro, it's 1 euro is equal to 1.6460 Aussie dollars. Those are the codes available in the market. Now, so you have given three market codes. The third one is the cross currency rate of the first two currency pairs. How do you discover whether there is an triangular arbitrage given the market rates? The first step, given the first two rates, Euro dollar and Aussie dollar spot rates, we have to calculate the implied Euro AUD cross rate. What are the given rates? Euro USD 1.0753, AUD USD 0.6535. The first step is to calculate the implied Euro AUD rate. How do you calculate this? In Euro USD, Euro is the stronger currency. In Aussie USD, dollar is the stronger currency. So therefore, in the the cross rate Euro and AUD, the stronger currency is Euro. Australian dollar is the weaker currency. Are they direct quotes or indirect quotes? Euro USD, is it a direct quote or indirect quote? It's an indirect quote. The same is true for the AUD USD as well. Okay, then how do you calculate Euro AUD rate? When you have two indirect quotes, even in the morning I remind you, stronger currency rate divided by the weaker currency rate. So stronger currency is Euro. Euro dollar rate is 1.0753. weaker currency is OC. OC dollar rate is 0.65. So you will get Euro AUD rate. So it should be
1654.
1.6454. Is it correct? 6454. Yes. Now you can see what is the market code. $1.6460. Market code is 1.6460. So there is a mismatch or a discrepancy. This reveals you that there's an arbitrage opportunity because market price is higher than the implied rate. Market price is higher than the implied rate, so the market is expensive. Implied rate is cheap. When you see something expensive, what do? You sell it in the market.
Sell
So
it.
in the market, you have to follow the rule, buy low, follow the rule, buy low, sell high. In the arbitrage market, to expedite it, explore the opportunity, we have to buy low and sell high. The same thing what we did in the special arbitrage. We bought at 25 and sold at 30. Buy low, sell high. So here, what is low? 6454. We should buy at this rate and sell at this rate, market rate. Buy at the implied rate, sell at the market rate. But there's a problem. If the market is caught in this price, how can you buy it at a different price, that implied price? You can sell it at the market. Since the market participants, they quote this rate, you can enter into a transaction easily to sell some amount of euro against Aussie dollar at this rate. That part is straightforward. You can buy you can sell euro against Australian dollar at 1.6460 because it is the market quote. But the problem is, how do you buy euro Australian dollar at this implied rate? To do that, we have to use these market rates and do another two rates. So that is given. So since in this example, implied rate is less than market rate, we have to sell euro AUD at the market rate. Then what do we do? So you have the first step. Sell euro and buy Australian dollar at 6460. This is the transaction that you do in the market. Then you have this much of Australian dollars. Is it clear? 1 million multiplied by 1640, you get this. The amount, that 1 million, is just an arbitrary figure. You can use in whatever amount you want, but this is easy. 1 million. So sell euro at 1.6460. So this is the first step. You begins with euro 1 million. You sell euro 1 million against OC at 6460. Then you get how many Australian dollars? 1.6460 into 1 million. That's the figure. That's the amount which is given here. Now what you can do? Now you have OC. You can sell this Australian dollar. The second step, you can sell this Australian dollar against USD at the rate given 0.6535, if I remember correctly. Yes, at 6535. You sell this amount of Australian dollar at the market rate to buy dollars. How many dollars will you get? How do you find it? 1.646 million Australian dollar, sell at 0.6535. So 1 Australian dollar you get, for 1 Australian dollar you get 0.6535 dollars. So in total what you get is 0.6535 into 1646. That's the amount given here. One 0.756661. Now you have dollars. Now you have this much of. Now you have this much of dollars. Now you have this much of dollars. The next step, what do you do? Buy back. Same euro, but against dollar. Now what you have at 1.0753. By having this much of dollars at this rate, how many euros that you can buy? How do you calculate that? for €1 you have to pay this much of dollars. So therefore you can buy 107,566 divided by 1.0753. This will be more than 1 million. So you started with 1 million. You started with 1 million and end up with more than 1 million. But you have to execute these 3 transactions very quickly in the market before they change the prices. By doing so, at the end, once you conclude all these transactions, you have earned a profit of $335.72. Sorry, euros. 335.72 euros. You have made the profit of that. The first transaction is sell euro, buy Australian dollar, because in the market this cross rate is expensive. So first transaction is that you buy this amount of Australian dollars, sell those Australian dollars against dollar at the market rate. You will get some amount of dollars. Use those dollars to buy euros at the market rate. You should be able to end up with more than what you have had at the beginning. That is when you have this situation. Implied cross rate is less than the market cross rate. So therefore the base currency is traded expensive in the market. Then we sell at the market rate and replicate the buy transaction through the other 2 trades. So this is the way how you explore whether there's any arbitrage opportunity. First thing to discover, you have to calculate the implied cross rate. You have to calculate the implied cross rate first, then see whether there's any mismatch. If the implied cross rate is higher than the market cross rate, then the market is cheap. You should buy from the market and sell it through the other 2 transactions. If the implied cross rate is less than the market cross rate, then the market is expensive, sell at the market. So just follow buy low and sell high rule. This is the example that we work out. First calculate the implied rate. You get 6454, which is lower than the market rate. So sell euro against Aussie dollar at the market rate, 6460. Then follow these two transactions. This is the first transaction. Sell at the market rate. You sell the base currency euro at the market rate. Get the counter currency Australian dollar. Then sell that Australian dollar against dollar to buy dollars. Sell that dollars to buy back euro at the market rate. These 2 transactions, all these transactions are done at the market rates, but the second trade and third trades are the replication of the buying transaction at the implied cross rates. This is the rate done at the market. The combination of these two will be the replication of the buying transaction at the implied cross rates. So the next example, it's other way around. If the market code is 6450, but for the cross rate, but other two remains the same. So again, to see whether there's any arbitrage opportunity, we have to calculate the implied rate. It is the same 6454. Now we can see implied rate is higher than the market rate. So what do? We buy euro OC at the market rate. So again, we can consider start with euro 1 million, but we keep this part as the last transaction, buying the euro AUD at the market rate. So first we start with euro 1 million. Then what we do? We sell euro at the market rate against dollar. We sell euro at the market rate against dollar. So if you sell 1 million euros at this rate, you get 1,075,300 dollars. Just multiply 1.0753 by 1 million, you get this figure. Then the second transaction is you sell these dollars against Australian dollar to buy this amount of dollars. You have the dollar amount, you have the exchange rate. How do you get this Australian dollar amount? Dollar amount divided by this rate, you get the Australian dollar. Now you have Australian dollar. Now you will execute the buying euro against Australian dollar at the market rate. So you have this much of Australian dollar. This is the exchange rate, cross rate applicable. 1645447 divided by 1.6450. You will end up with more than 1 million euros, 272 euros profit. So this is an example of when the implied rate is higher than the market rate. What to do? You have to buy the base currency at the market rate. Is it clear how to explore the triangular arbitrage? First thing, how to identify whether there's an arbitrage opportunity. The second thing is how to get the advantage of that arbitrage opportunity and what are the trades that you have to carry out to earn that profit. Is it clear? Any questions?
When it comes to this implied rate is higher than market rate, what we need to do is sell high and buy low. Is it?
Whatever it is, you sell high, buy low. Buy low, sell high. That's the rule. Okay, in this,
okay.
Whatever it is,
okay,
buy low, sell high. So since in this case implied rate is high, market rate is low, you buy at the market rate. What do you buy? You buy euro against Australian dollar at the market rate. So market rate is 1.6450. Okay. To buy that, what you need? You need Australian dollar. How do you find Australian dollar? You buy Australian dollar against dollar at this rate. I'm explaining how do you go back this cycle.
Yeah.
So you want to buy euro at giving Australian dollar at the market rate, but you don't have Australian dollar. To do that, to find Australian dollar, you buy Australian dollar against dollar at the market rate. But to do that, you don't have dollars. So you sell euro against USD to get dollars. Once you do all three transactions, you don't have to invest any cent at the account. If what you need, like euro 1 million just to settle one transaction, then it will settle the other transaction. Likewise, it will settle everything and you end up with a profit. If you can do netting, you don't need any cent. At the end of the settlement date, you will get the difference, 272 euros in your account, if you can do the netting. If not, what you need euro 1 million. It will settle this transaction, then it will automatically settle this. Ultimately you end up with this amount in the account. It's just, but end of the day you don't invest anything, because within this, even though you keep 1 million euros in the account, at the end of the day, closing of the date, you will get back this amount of euros. So basically you haven't invested anything. So again, to explain you, since implied rate is higher than the market rate, you have to buy at the market rate. To buy euro against OC, you need OC. How to generate OC? Buy OC against dollar. To do that, you need dollars. How do you generate dollars? You sell whatever the euros you bought here against dollar. Same thing. And the other thing is, in my example here, we start with euros and end up with profit in euro. Not necessarily. You can start with OC dollar, 1 million OC dollar, go around it, end up here, you will earn profit in dollars. Or if you want, sorry, you will end up with profit in Australian dollars. If you want to make the profit in dollars, start from dollar 1 million, go around, you will end up with some amount profit in dollars. It's not necessary to be the base currency in the pair, but it is easy to understand.
Thank you, sir.
Is it clear? Did I answer your question?
Yes, sir. Yes.
Okay.
Clear. That's clear.
Okay. Shall we move into the next topic, covered interest arbitrage? Again, as I mentioned at the beginning, this opportunity exists if the market forward rate is different or deviate from the implied forward rate. What is the implied forward rate? Given the spot rate and two interest rates, we can calculate the forward rate. If that calculated forward rate is different from the forward rate quoted by the market, then there is an arbitrage opportunity. Got it? Given the spot rate, two interest rates, we can calculate a forward rate. If that forward rate is different from the market call, then there is an arbitrage. That arbitrage is we call covered interest arbitrage, because this comes through these interest rates. So for an example, the spot rate is 1.0752. 90-day interest euro 2%, for euro it's 2% and dollar it's 3%. But in the market, 90-day euro dollar forward is 1.0775. Again, how do we identify whether there is any arbitrage opportunity? What do? Given the spot rate and two interest rates, calculate the forward rate. So this is the equation to calculate the forward rate. So substitute the figures. Spot rate is 1.0752. The counter currency is dollars. Dollar interest rate is 3%. Base currency is euro. Interest rate is 2%. But the forward is for 90 days. So 90 over 360. If you do the calculation, you will get 1.0779 as the answer. So that's the implied, this is the implied forward rate. What is the implied, sorry, what is the market forward rate? 1.0775. 1.0775. So the market forward rate is less than the implied forward rate. So therefore market is cheap. Better you buy from the market at the forward price. So buy forward at the market. So you buy forward at the market, then you get the exposure. How do you cover? You have to sell a forward. The difference, buying and selling price, the difference is the profit. How do you sell? That can be done through some borrowing and lending. At time 0, that means on the trade date, you have to carry out these 4 transactions. The first one is buy euro dollar 90-day forward at the market rate. Euro dollar forward at the market rate is because market forward is cheaper than the implied rate. So therefore you buy at the market rate. So then what would happen? In the timeline, you agree to buy euro. This is the forward date, forward settlement date. You agree to buy, yes, euro at 1.0775. Okay. To buy euro, you need dollars. Need dollars. You don't have dollars. What do? You need dollars on this date, not today. But what you can do? So you need dollars in future. You can therefore invest USD for 90 days. In this example, the period is 90 days from the spot date. So you invest some amount of dollars for this period. To invest dollars, you need dollars today. How do you generate dollars? You don't borrow dollars today. Instead, what do? You borrow euro. Why do you borrow euro for 90 days? Now you have already created the euro inflow in the future. Now you have already created the euro inflow in the future. So you borrow euro today. Therefore, at the end of the period, you can use this inflow to settle this borrowing. That's the concept. So you buy euro in the future. Therefore, you borrow euro today. Then you sell this euro against what's the currency you need? USD. This USD you invest for a 90-day period. So at the end of 90-day period, you will get the inflow of dollar deposit. You can use that dollar inflow to buy this euro based on the euro forward rate that you entered into today, and you get euros, and you have a liability to pay back this euro borrowing. Use this euro amount to pay back your borrowing. Once you complete this circle, again you will end up with some excess money. That is your profit. That's the concept. So that's why these 3 transactions, this is 4 transactions. This is the euro dollar forward buying at the market rate because it's the cheapest one. Since you buy euro in the forward, you borrow euro today, paying 2%, and sell those borrowed euro against dollar at the spot rate and lend those dollars that you received for 90 days at 3%. So note that you borrow euro at 2%. Whatever the interest rates that we use to calculate the forward rate. Sell euro against dollar at the spot rate. The spot rate that we used to calculate the forward rate. And lend dollars at 3%. Again, this is the interest rate that we use to calculate the forward rate. You should be able to borrow, lend, and convert for exchange at the given rates. Otherwise, you may not be able to explore the arbitrage opportunity. So there may not be a arbitrage opportunity. So the basic assumption behind this is market participant can borrow and lend any amount at these market rates and enter into spot transactions and forward transaction at the market rates. Under that assumption only, these will work. So after 90 days, what would happen? You receive dollar with interest because there was a lending. Whatever the amount you lend, you will receive that the principal and the interest. Then you had a contract to buy euro against dollar in the forward market. So you use the dollar inflow to honor that forward contract. So then you get euro. You can't keep that euro because you have borrowed euro. So you have to honor that one as well. So whatever the euro amount you not the exact amount, but use this euro inflow to pay your borrowing. If there's any excess, it would be the profit again, whether it's the profit is in dollars or euros. That depends on how do you execute the transaction in which currency. So this is in summary. At times 0, you enter into this transaction. Buy forward euro 1 million at 1.0775. Remember, for a forward transaction on the trade date, you just enter into the agreement. You don't exchange any money. You do that on the settlement date. After 90 days only, you pay the equivalent amount of dollars and you get euros. So at this rate, you need to pay $1,077,500 to buy euro 1 million. Now, what do? We calculate the present value of this euro 1 million at the same rate of 2%. You will get this amount. That is the amount that you have to sell in the spot market. That is the present value of the future euro amount is the amount that you have to sell at the spot market. So you enter into sell this amount of euro, and at the market rate of 1.0752, you will get $1,069,850.75. When you sell this amount of euros at the current spot rate, then to sell this amount of euro, you need euro. So you borrow euro, the same amount at 2% for a 90-day period. You borrow you borrow euros, sell those euros and buy dollars. Now you lend those dollars for a 90-day period at 3%. So these are the transactions that you execute today. What would be the result at the end of 90-day period? So you lend $1,069,850 at 3%. So that will grow to $1,077,874 because you earn interest at 3%. So the future value of this dollar amount is $1,077,874. Now you receive this amount of dollars. What do? You use part of it to honor your euro dollar forward contract where you buy euro. What is the amount that you pay? It's only $1,077,500. From the deposit or the whatever loan, you get $1,077,874. there's a difference of $374.63. Use this dollar amount, part of it, to buy euro 1 million. But since we borrowed only the present value of euro 1 million at 2%, this borrowing will grow to euro 1 million at the end of 90 days. So what you have to do, whatever the euro that you bought here, just deliver it to the lender. Then you honor that transaction as well. So you end up with a profit of 374.63 of dollars. So these are the trades that you have to carry out if the implied rate is higher than the market rate. You carry out the reverse transactions if it is other way around. So in this example, the market forward rate is 1.0785. So you can remember what is the implied forward rate, 1.0779. 1.0779 is lower than the market rate. So the market forward rate is greater than the implied forward rate. What does it mean? Market is expensive. So you have to sell at the market and buy through the borrowings and lending. So therefore you sell euro USD 90-day forward at the market rate. You do it today at t equals 0. Since you sell euro in forward, when you sell euro in forward, you will get dollars. So you create a liability in forward. That is, you borrow dollars for 90 days. Then you have to pay some dollars to fulfill this liability. So therefore you borrow dollars for 90 days at 3%. Then you sell those dollars against euro at the spot rate. You invest that euro at 2% for the 90-day periods. So these are the transactions that you have to carry out at the beginning or on the trade date. After 90 days, that means on the settlement date of the forward transaction, since all the borrowings you did for 90-day periods, you will receive euro with interest because you had a lending transaction in euro. You receive euro with interest. Then you have to pay euro to buy dollar as per the forward contract. You enter into sell euro against dollar. So whatever the inflows generated through this lending, you use to settle this transaction, pay euro to buy dollar as per the forward contract. Now you get dollars, but you have a dollar liability because you borrowed dollars for 90 days. Now you use these dollar proceeds to pay the lender. There should be excess, that is your profit. So when we put it into numbers, it is like this. So again, sell forward euro at 1.0785. That means you expect to receive $1,078,500 in future. Again, we calculate the present value of this euro 1 million at 2%. Still the same figure we get. But since we are buying euro this time, we have to sell the same amount of dollars. Whatever the euros we bought, we lent it at 2%. So after 90 days, it will be 1 million. And to sell dollars, we have to borrow dollars. We borrow this amount of dollars at 3%. At the end of 90-day periods, it will grow to this $1,077,874. Now you can see there's a difference, dollar difference between what we receive and what we pay. Here we receive 78,500, but we have to pay only 77,874. The difference is the profit in dollars. So if you sell forward, remember, you sell forward, then you lend euro. To lend euro, you need euros. For that, you buy from the spot market. To buy that, you need dollars. You fulfill that dollars through a borrowing. So logically, you can connect one trade to the other. Or you can just remember these steps, but if you are to remember these steps, be careful. You have to use the currencies properly. In this example, it's euro dollar. What would happen if it is dollar yen? Whether you receive dollar in future or yen in future, so there will be a confusion. So be clear about the logic behind these transactions. So that's the end about arbitrage in FX market. We discuss about 3 types of arbitrage: special arbitrage, cross currency arbitrage, and covered interest arbitrage. So we have about 10 minutes. If you have any questions, you can raise it. Yes, I know this may be a bit difficult. You feel like difficult, but think about it leisurely. What would happen if I buy forward? If I buy forward something, I have some inflow and outflow. So if you don't want any inflows and outflows, what are the transactions that you should carry out to settle all those things? So there's a euro 1 million inflow due to this buy transaction in 90 days. Create a euro 1 million outflow. How you can do that? Create a liability 1 million in future. To create a euro liability, you have to borrow euro. So you borrow only the present value of that. Okay, you borrow, this inflow will be settle each other, but you need dollars to pay. How do you generate dollars in future? You create an asset in dollars. That means you make a deposit in dollars today. So you made a deposit, but to make the deposit today, how do you find dollars? You have that borrowed euro, sell it at the spot market to create the dollar or meet the dollar requirement on the spot rate. That's how you connect one to the other. So if you have any questions, it's time. Probably next week we'll discuss about how to use forwards and swaps, FX swaps to hedge foreign exchange.
Next week also, sir, are we going to have online classes, so are we need to come to IBS, sir?
I think still it's the online.
Okay.
They will let you know if the circumstances change. If you want to come here, yes, they will let you know in advance.
Okay. Thanks.
Okay, thank you. Anything else? So if you don't have any questions, we'll stop here. As I mentioned, next week also will be on foreign exchange markets, how to hedge. So therefore you need the understanding about the spot market and the forward markets. Please revise what we discussed so far. Then it will be easy to understand how to hedge the FX exposure using FX forwards. There are other derivatives that you can use to hedge FX exposure, but we are not going to discuss those because we haven't discussed those products. Since we have discussed FX forwards, I'm going to explain how to hedge your exposure using forward transactions. So please be ready for that. So I think you don't have any questions. I can see you are walking away. So we'll stop here. See you next week.
Okay, thanks.
Thank you.
Thanks. Bye.
Thanks. Thanks.
Thank you.